Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. Markets in the Asia Pacific are on the back foot a bit today. This is after a sell-off among big cap tech stocks in the U.S. Shares in NVIDIA were down 3.5% in the Tuesday session. The chipmaker will be reporting earnings next week, and in a moment we'll get the view on markets from Gene Goldman. He is the CIO at Cetera Financial Group. But we begin this morning in the Lion City of Singapore. Joining us now is Ritesh Ganeriwal. He is head of investment and advisory at Syfe. Ritesh, thank you so much for making time to chat with me. Let's begin with the global macro right now. There's so many forces at work. Inflation seems to be stubborn in many jurisdictions. Equity markets are at or very near all-time highs in many cases. Certainly that's true in the U.S. and in Japan as well. And there's concern about weaker growth going forward. How do you see the overall landscape these days?
Absolutely. I think, number one, you've seen, growth concerns start to trickle in much more prominently over the last few weeks. Especially if you look at the unemployment data, I do believe the central banks are underestimating the labor force weakness. We have seen below trend jobs data over the last 3 months now with, May and June data kind of like revised down into the tens of thousands, right? And even the labor force participation is down to 62%. Combine that with the fact that if you need full employment, you need at least 80,000, jobs created. If there is any further downward revisions and downsides to this jobs data, that can have a pretty meaningful effect on the unemployment rate. And that's part of the reason why you've seen kind of like a reversal from July to August in terms of, the expectations of a Fed cut coming in September. Now there's almost like an 85% plus, probability that the Fed will start cutting, from September onwards, like we'll obviously hear from Jackson Hole. But essentially, we are now, starting, with the Fed pivot in September. This is one of the calls that we had, made as part of our H2 outlook as well. And while I guess on inflation, if you, just read the latest data, while the PPI was hot, the headline inflation is still, manageable and soft overall and absorbing all kind of like tariff related aspects as well.
When I listen to you, you don't seem to be too concerned that inflation could prove to be a little stubborn here. You referenced the hot PPI that we had in the States recently. Let's remember, too, that Japan has been in a inflationary environment, well above target for some time. I think the exception is probably the story in China. Wouldn't you agree? But I'm wondering whether or not there is a risk that inflation could prove to be a little sticky.
See, I think fair enough. And yes, it could prove to be sticky. But when you think about on the balance, when there are two forces in play with respect to employment and inflation, the Fed cannot, ignore the fact that the labor market is showing clear signs of weakness. So that will start dominating, conversations as we move forward. And part of the inflation obviously is tariff related, which could be temporary to begin with. And as you can see, it is reflecting more on the good side rather than the services side. So again, while, the next couple of months could be tricky in terms of really ascertaining, are we on a disinflationary path still, or, the inflation, picks up a bit. But overall, I think between the two forces, if labor market weakness continues to hold, that's what is going to dominate what's going to happen with the Fed.
I'm curious about opportunities that you're seeing, particularly in the Asia Pacific. We can talk first about Japan. We know the Nikkei is not far away from an all-time high. What is driving this, do you think?
So number one, I think the biggest macro stories this year has been the depreciation of the US dollar. And what that tells you is that the US is no longer the only game in town. After years of US dominance, actually non-US equities have outperformed in the first half of the year. And led by, China, led by, developed ex-US countries as well. And almost 50% plus of that was driven by the US dollar depreciation. So the bar for you to invest into the US becomes much higher in terms of, the returns that you're expecting. In the first half, as a Singapore dollar investor, S&P up 6%, but US dollar depreciated by more than 6%. So you're net zero versus if you are a more globally diversified investor, you would be much better off. At Syfe, we have seen clients on the margin putting new money into the Asia Pacific and emerging markets region. These countries tend to do well when there is a dollar weakness happening. And this can continue. After this brief pause in July, you're seeing that dollar weakness starting to kick off again. And what that means is, if you look at whether it is the Japanese market, the Chinese market, or the global, broader EM market, these are markets that stand to benefit.
So you mentioned the Chinese market. On Tuesday, we had the Shanghai Composite closing at the highest level in about a decade. And I'm curious about this story because we know there seems to be a bit of a disconnect between what happens in the equity market in China and how well the economy is performing. Do you have a sense of what is driving the price action in China right now for the mainland markets?
Yeah, absolutely. Look, I think overall, while there are structural challenges in the Chinese economy, the reality is we are seeing a China that is moving from this old economy to a new economy. And the old economy, which was more manufacturing and export-led, is transitioning to a more consumption-driven economy. And what that means is if there is signs of domestic demand coming in, targeted stimulus measures, et cetera, and all, then countries like China can do really well. And if you look at opportunities within China and the new China sectors that are interesting, it comes down to your renewables, your electric vehicles, the AI story is panning out much more strongly in China. If you think about the aging population, healthcare, and the consumption from the internet e-commerce side and all, these aspects and sectors within China are the reasons why you can expect a much superior risk-return profile from these parts.
I think the export economy in China has been one of the bright spots. You mentioned the domestic demand story. That seems to be a little dubious right now, and I'm wondering whether you're expecting that the government is going to have to do more in terms of stimulus here to really kick things into the next gear.
Absolutely. Look, I think that is a much needed expectation, and there have been some measures to that regard. But obviously, there is a lot of investment that is currently going on within China to reposition themselves. And I agree with you that the exports have been the bright spot from a Chinese perspective. But this is also an area where it can continue to be volatile, and we will know as we move forward how things pan out from a tariff standpoint, et cetera. But overall, I do see things thawing down, which in a way is great because you're now not just benefiting from that export sort of kicking in and back up, but also the domestic aspects becoming much better.
Do you believe that India has the potential to challenge the Chinese export economy in a major way?
See, I think again, compared to China, actually India is already a very domestic consumption story. So overall, right now, if you think about the relative positioning between India and China, there was a shift from China to a more, India-led export-based proposition, and especially if you look at Apple, et cetera, they have moved their factories into India and trying to manufacture iPhone, et cetera, from there. But again, there is a lot of uncertainty. India has been slapped with 25% tariffs relative to China, which can be slightly lower at this juncture. And then there is an additional 25% for them buying Russian oil. I do believe some of these will be sorted as we move forward, especially on the geopolitics front. I see things becoming much better and that in a way benefiting India over time. But overall, I would say that, yes, the export side right now is much more of a concern on India, given the tariff overhang. But the domestic consumption story is what I think will position India for the greater good, if you think about it, from a 5 to 10 year kind of horizon.
Ritesh, we'll leave it there. Thank you so very much. Ritesh Ganeriwal is head of investment and advisory at the firm Syfe, joining us here from Singapore on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. So, as mentioned, markets are bracing for Friday's speech from Fed Chair Jay Powell at the Jackson Hole Symposium. Today, we had yields edging lower across the curve as the market seemed to add on bets for a September rate cut. The 10-year lost about 3 basis points in New York trading. We were last quoted at around 4.30%. Joining me now is Gene Goldman. He is the Chief Investment Officer at Cetera Financial Group, and I'm pleased to say that Gene is here in our New York studio. Thank you for stopping by. Are you still constructive on this market right now? We were talking before we began to go to air here about the fact that things seem to be priced a little bit for perfection.
Yeah, and I totally agree. So I do think everything is priced for perfection. But I think what we've been telling our Cetera advisors is simply this: expect a 5 or 10% pullback. And you can point to 3 things. As you've mentioned, high valuations, uncertainty around earnings, and a third point, this just confusion amongst the Fed. If you think about valuations, S&P 500 has rallied 28% off of its market low, fastest in 50 years. And at the same time, market breadth has been terrible. And at the same time, price earnings ratio is about 22.5 times forward earnings. Earnings are uncertain. Earnings have been great. They're uncertain going forward. High inflation, slow economic growth. And what really bugs me the most is that if you look at the Fed's survey of CFOs, hundreds of CFOs were asked. 30% said we are going to eat the tariff costs, and that's going to impact profit margins. That's pressure on near-term earnings. And then the last point, the Fed is just confused. They are in a tough predicament. I know you alluded to Jackson Hole earlier. Jay Powell, he's not going to be a dove. He's not going to be a hawk. He's going to be a very wise owl. And he's going to say, we are very data focused. And if I'm Jay Powell, I'm in a tough situation because I'm concerned about rising goods inflation, rising services inflation, and the fact that, yes, the labor market's slowing down, but average hourly earnings rose.
So if you got weaker growth, and that's part of the story, and stubborn inflation, while at the same time you have a White House that's going to be putting pressure on the Fed to cut interest rates, not just in September, they want to see multiple rate cuts. What kind of dilemma does that set up for the Fed when you're kind of easing into a cycle where, yeah, growth may be slowing, but inflation is stubborn?
It's a terrible dilemma. I mean, go back to the dual mandate. The dual mandate says, obviously, everyone has jobs and keep inflation in check. The dual mandate, the labor market is slowing down. Is it really that bad, though? 4.2% unemployment rate, 220,000 jobless claims each week. That's about 4% unemployment. And average hourly earnings, as I mentioned, higher than expected. And we have more jobs out there than people looking for jobs. The labor market's okay. This gives the Fed some time to say, let's wait and watch. And then the inflation story, yes, I'm worried about that. That's a big story.
So you believe that the market maybe is a little too optimistic about rate cuts?
Yes. Right now, the market's saying 2 or 3 cuts. I'm on the 1 to 2 cuts. And I'm just being nice. I think it could be closer to 1.
Where are you finding opportunity these days if everything is so expensive?
Yes. So right now, we're trying to be more focused on the conservative side. We do think stocks will pull back. So with that in mind, a little bit biased towards conservatism. So we like small caps. I know small caps are very high beta to the market, but with a PE ratio of 8 times forward earnings next year around 21 times, increasing 21 times, and when the Fed cuts rates, market breadth tends to widen. So small caps, mid caps, we like value. We like value for a while, and we like within value financials and industrials.
But isn't there a big risk, to go back to the small cap story, if the economy begins to slow?
Yes, but it's not. We don't see a recession anytime soon because the economy is stable enough. Yes, things are slowing down. Yes, housing is slowing. Yes, the employment picture is slowing down a bit, but we're not in dire needs. Productivity is still pretty strong, albeit it's pulled back a bit.
Let's talk a little bit about the artificial intelligence trade. We get NVIDIA earnings next week.
Yes.
Today, the stock pulled back about 3.5%. Talked about rich valuations, particularly in certain pockets of tech, mega cap tech especially. Where do you find yourself in terms of the AI trade? Are you inclined to kind of stay on the sidelines right now, given the valuation story, or is it just simply too compelling that you have to be in there and participate?
Well, first of all, let's take a broad picture. We believe AI is the future. AI is like electricity in the 1890s. It's going to be so big. So it's an important aspect of our society on a go-forward basis. But just like the tech bubble back in the late 90s, you have to look at an investment with valuations, fundamentals, and technicals. Let's throw out technicals. Valuations are super high right now for AI. So for us, we are being very selective in technology. So we like some AI companies. We do like some services companies. We do like software. We do like cybersecurity. But in the AI play, we look at areas next along the continuum, not just semiconductors, but looking at applications, looking at the next level of where AI is going. Applications, quantum computing, things like that, we think will be much better.
So broadly speaking, today we saw maybe some rotation out of tech and into some of the undervalued, underloved names, particularly where the American consumer kind of intersects the market. Would you be inclined to lean into the consumer at this point, particularly when you look at a name like Home Depot that was up by more than 3% today?
We would pause on the consumer a little bit. We do think the consumer, yes, average hourly earnings, again, are rising above inflation, but let's pause on the consumer. Yes, the consumer is doing okay on the upper end, but the lower ends are really, really struggling. And I think that sneeze we saw today in the last few days in terms of AI, that reminds me of DeepSeek back earlier this year. That's sort of, oh my God, we have a very concentrated, very focused market. Right now, top 10 names in the S&P 500 are about 37% of the index. That says that any sneeze, any misstep, any uncertainty rising has a detrimental effect to the index. And we saw that today. We saw the rotation away from momentum names, again, the AI names, into low volatility, low momentum names. And I think that's going to continue as the markets start to reprice themselves.
So you mentioned the housing market a moment ago. After the bell, we heard from the luxury home builder Toll Brothers. The company missed street expectations. It seems like there are issues around affordability, maybe a little bit of economic uncertainty holding back buyers too. Maybe even the interest rate story is a part of the narrative here. How do you feel about a company like Toll Brothers?
Yeah, it's hard for me to comment about companies, but let's just say home builders in general. The home building area is struggling right now. You see inventories rising, you see prices are coming down, and you saw today building permits came in lower than expected. But keep in mind, building permits are still well above where they were back in the 2010s. So we're not too concerned. Plus, you've seen a huge run up in some of these names. So we'd watch carefully in terms of home builders.
Are you looking at opportunities offshore? We're talking a lot about the dynamics that we are seeing here in the U.S., but I'm curious as to what you're finding in areas, maybe Asia or Europe.
Sure. In our portfolios today, we are neutral to slightly underweight international. If you look at the benchmarks are about 65% U.S., 35%, give or take, international. So we're a little bit less than that. We actually are looking to reduce some of our international exposure pretty soon because we do think the dollar is going to reverse. We do think there's going to be upward pressure on the dollar. Most of the returns internationally have been driven by the weaker dollar. We think that's going to reverse pretty fast, pretty quickly. And with that in mind, we want to be more U.S. focused.
So is part of the dollar strength story that you're expecting tied to the fact that maybe the Fed is going to be more in a box and unable to easily kind of accommodate the market in terms of rate cuts?
Yes, part of that, and the whole fact that other countries will be cutting rates faster than the U.S. Economic growth is faster here than other countries. And the demise of the U.S. economy that's been so over-exaggerated, we think that's over-exaggerated. The U.S. economy, while it will slow down, will not slow down as fast as other countries, nor will it struggle as much.
So if you're expecting a pullback in the near term, I'm curious as to where you're hiding out. You talked a little bit about value, but I'm looking at the fixed income space and wondering if you're playing the bond market a little bit.
Yeah, and for us, we're not market timers, so we're big believers in diversification. And keep in mind, over the last 45 years, the average intra-year loss in the stock market is negative 14.1%. Pullbacks are normal. We prefer to be diversified as opposed to market timers. So on the domestic equity side, we're overweight liquid alternatives. So stocks that zig when the rest of the market is zagging. On the fixed income side, we have a benchmark duration, but we've been slowly moving money more towards the longer end in order to raise our duration because we do believe, let's say the Fed makes a mistake and the Fed has to cut rates more than expected because they're close to a policy error. That's going to benefit the duration standpoint.
Even if you feel that there is risk that inflation is stubborn, you're going to play the long end?
We will play the long end because we do believe the Fed, near-term inflation will be a little bit stubborn, but then there comes a point where the Fed likely makes a mistake. 8 of the last 9 rate hike cycles, the Fed has made a mistake. We think that likely happens again because they're stuck in a quandary right now. So we do believe the Fed could come in, have to play catch-up, putting downward pressure on rates later.
Gene, we'll leave it there. Thank you so very much. Always a pleasure. Gene Goldman is the Chief Investment Officer at Cetera Financial Group, joining us here in New York on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.